we are trying to express the price of one unit of currency in terms of another. I am trying to express dollar in terms of, let's say, Indian rupees, or I am trying to express euro in terms of US dollar, or I am trying to express US dollar in terms of Australian dollar. So we are trying to establish one currency in the form of other, right? One unit of one currency is equal to how many units of another currency, and that is what we are calling as exchange rate. And what we see is in the foreign exchange markets across the world, for each exchange rate, for each currency, there is a 3-character code that is standardized. Like dollar, US dollar, we represent it as USD. For Japanese yen, we represent it as JPY. Or for Indian rupee, it is represented as INR. And euro, EUR. Australian dollar, AUD. So we find some kind of a standardization in terms of the notation used for the different currencies across the world. Now, from the representation perspective, we commonly see that the representation goes like this: 63 INR per US dollar. What does it mean? 1 US dollar is worth 63 Indian rupees. This is called as a direct currency code. So wherever we are using the word direct currency code, we have two types of quotations that we commonly observe. When I say direct currency quotation, we try to exhibit the domestic currency and the foreign currency in this manner per one unit of foreign currency. So if I am saying in this case INR is my domestic currency, because in a direct currency quote I will be writing it as per one unit of foreign currency, how many units of domestic currency is required. To buy 1 unit of foreign currency, how many units of domestic currency is required? So in this case, the domestic currency is called as the price currency. I call domestic currency as the price currency, and the foreign currency is called as a base. So for 1 unit of base, how many units of price currency is required is what is a direct currency quotation. So 63 Indian rupees, which is the price currency, per 1 US dollar, which is the base currency. But whenever I talk about the indirect quote will talk about 1 unit of domestic currency, right? We talk about per 1 unit of domestic currency, how many units of foreign currency. So how do I get that? So 63 Indian rupees per USD. So if at all I have to talk about per 1 rupee how many USD, I am directly taking 1 by 63. So 1 by 63 USD is the value of 1 INR. This is the indirect quote. So 1 INR is equal to 0.01 something USD. This is coming out as the indirect quote. But if you observe here, if US is the domestic currency, then this would be the direct quote. If US is the domestic currency and Indian rupee is the foreign currency, then it could be written as 1 by 63 USD per INR. This would be a direct quote for a person operating in US, whereas the same would be an indirect quote for an investor in India. Similarly, this is a direct quote for an investor in India, but it would be an indirect quote for an investor in US, right? So the direct and indirect quotes need to be comfortably understood. And in most of the times, we see that the exchange rate is established in nominal terms. When I say it is established in nominal terms, there is an impact of the purchasing power in both the countries. The inflation of both the countries is taken any nominal terms is the real term, plus even it takes into consideration the inflation impact. So the inflation differential of the countries is also taken into consideration while pricing the while expressing the exchange rate quotation. So when I look at it purely from a real exchange rate perspective, means removing the impact of inflation or the pricing power, relative purchasing power parity or pricing differentials between the countries, the best way for me is to remove the pricing influence of the countries. So take the spot exchange rate. So 63, I take the spot exchange rate, multiply it with the some kind of a pricing index for a foreign country. So I take the CPI of a foreign country. If I'm taking a consumer price index as a measure of pricing power in both the countries, I take the pricing power of domestic as well as the pricing CPI with respect to the foreign, and based on that I try to exchange the nominal spot rate to arrive at the real exchange rate. So it is taking into consideration the relative purchasing power of the currencies over the time. So if this number is increasing, so the purchasing power of the domestic currency is completely decreasing and vice versa. So whenever I am seeing a real exchange rate has gone up, it's a clear indication that the real purchasing power of the domestic currency has decreased and vice versa. So that's where we are simplifying it. Any exchange rate decrease. So if I say using this direct quote, let's say instead of 63, now the exchange rate has become 62. INR 62 per USD. What does it mean? 1 USD now is only 62 rupees instead of 63. Means USD, the foreign currency, has weakened, or I can say the Indian currency, the domestic currency has strengthened. So that is where we use the domestic currency has appreciated and the foreign currency has weakened or depreciated. So in case of direct exchange, when I am looking at and I am seeing that the number has gone down, I say that the domestic currency has appreciated and the foreign currency has depreciated. And if I see that the number has gone up, it means the weakening of the domestic currency or depreciation of the domestic currency. So this kind of understanding between when do we call something as depreciation, when do we call something as appreciation, we really need to understand by looking at the quotes. Typically, whenever we look at the foreign exchange market, it's one of the largest, or it's not one of the, it is the largest financial market, especially if I am looking at the average daily turnover perspective. So from volume wise, from a daily turnover perspective, huge trading is carrying on in this particular market. There are different kinds of participants in this market. We have MNC banks, large MNC banks across the world who are majorly into the selling of the currencies, selling of different currencies. We have participants, fund managers, probably they could be simple mutual fund managers, or we have hedge fund managers, or any other fund managers, portfolio managers, investors, corporations, government, central bank. Lot of these guys getting involved in buying of foreign currencies, different kinds of foreign currencies across the world, and they have different motives. Some of them may purchase it for hedging their exposures to foreign exchange risk, which means they must have invested heavily in some assets abroad. So their asset, let's say an Indian company has purchased some kind of properties, let's say in US. So the asset is purely exposed to the exchange rate fluctuations. So if they really want this exchange rate to be frozen, they can try to get into some kind of an instrument which can freeze the exchange rate between US and India, because for them, if the exchange rate is worsening, if the domestic exchange rate is if the domestic currency is depreciating, they are going to get much more. But if the domestic currency is appreciating, they are going to get much lesser, right? So for those who are having assets in US, a depreciation of the currency is much advantageous, but an appreciation of the currency is going to be a problem for them. So to mitigate their risk, they try to get into the exchange rate transaction where they want to sell dollars for a fixed amount of rupees. So that they are going to get fixed rupees irrespective of whether the US currency has appreciated or depreciated. So this is where the hedger's role is coming into picture. Whatever their existing exposure to the foreign exchange is existing, they want to mitigate that risk. So they are playing the role of a hedger. And in some cases, we see that they play the role of speculator, which means they forecast that the exchange rate is going to increase or decrease. So probably if they are visualizing that within 6 months, the USD relative to INR is going to appreciate, right? So right now it is 63. So what they would be typically doing is they will purchase the USDs. Let's say using 6,300 bucks, they are going to purchase 100 USD, right? Buy 100 USD. So using 6,300 Indian rupees. Now, if they are forecasting that the USD is going to strengthen and it is going to INR 65 within 3 months or within 6 months, now after 6 months they are going to sell this 100 USD and they are going to get 6,500 bucks, right? So this is the typical speculator's role. He is not having any kind of exposure to any foreign exchange risk. He wants to take a risk under the betting scenario that the exchange rate is going to go up or go down in the future. So that's one more motive, because if there are some parties who are willing to reduce their risk, there should be some parties who are willing to take the risk, because at the end a transaction is primarily a transfer of risk from one party who does not want to take the risk to another party who is willing to take the risk, right? And the understanding of this foreign exchange market is very much